Hey guys, myself MJ Bharati, Assistant Professor, Department of Commerce CA in Madurai Sivagasinada's Pioneer Meenakshi Women's College. In this video, I am going to explain about tax treatment of retirement benefits like gratuity, pension and leave salary. Let me start with the gratuity. So gratuity comes under section 10 and subsection 10. The gratuity means payment to an employee in respect of service rendered to the employer. The first one is if he is a government employee or the employee of the local authority, the entire gratuity amount is exempted. If the employee is covered by the Payment of Gratuity Act in the sense, the least of these three things can be taken as a exempted one. The first one is actual gratuity received, second one is maximum limit 20 lakhs, and third one is lost drawn salary into 15 by 26 into number of years service. Salary is equal to basic plus DA. DA includes the DA and as well as the DASB. DA means service allowance, DA means dearness allowance, and DASB in the sense dearness allowance for service benefits. Fraction in the service year, if it is exceeds 6 months, can be taken as a whole year. If it is 6 months or below 6 months, it can be ignored. And third category is that if the employee is not covered by the Payment of Gratuity Act in this sense, the least of these three things can be exempted. First one is amount of gratuity received and second one is rupees 20 lakhs and third one is 10 month of average salary into half into number of years service. Whichever is less is exempted. And then here the average salary is calculated by taking average salary of 10 months preceding the month in which the retirement or the death, which means the month before the retirement or before the death has to be taken for the consideration. If there is a fraction in the service, it has to be ignored. The salary is equal to basic plus DASB plus fixed commission on turnover. It can be included, it can be taken as a salary. Let me show you the problem. So here Mr. A is an employee of MN Limited, received rupees 68,000 as gratuity. He is covered by the Payment of Gratuity Act 1972, which means the second category. He is covered by the Payment of Gratuity Act. He retired on 15th July 2022 after rendering service of 36 years and 9 months. Here his experience is 36 years and 9 months covered by the Payment of Gratuity Act. If it is covered by the Payment of Gratuity Act, the fraction is more than 6 months in the sense it can be considered as a whole year. Therefore, the number of years service is 37 years. So, his basic salary is 3,200 and DASB is rupees 1,000. So, the salary can be include salary and as well as DA. So 3,200 plus 4,000. That has to be taken for the consideration of salary. Let me show you the solution. So computation of taxable gratuity of Mr. A for the assessment year 2023 to 2024 covered by the Gratuity Act. So first we are writing the gratuity amount received so that from that we can deduct the exemption amount. For exemption amount we have taken gratuity received 68,000, maximum limit 20 lakhs. And then third one is lost drawn salary into 15 by 26 into number of years service. So lost drawn salary 3,200 plus 1,000. It has to be multiplied by 15 by 26. Again multiplied by 37. That is number of years service. So here the 37 how it came? 36 years and 9 months given. It is covered by the Payment of Gratuity Act. So the fraction is more than 6 months in the sense it can be taken as a whole year. So that we have taken 37 months. That was given in the notes. So 68,000, 20 lakhs and 89,654. By comparing these three things, 68,000 is the least figure out of these three. That has to be deducted as a exemption amount. So that the taxable amount will come nil. Let me show you the next problem. Arun, an employee of AB Limited, received rupees 96,000 as gratuity and covered by Payment of Gratuity Act. Here they have given not covered by the Payment of Gratuity Act. So he retires on 31/1/2023 and after 28 years and 9 months service. Here 28 years and 9 months given, but it is not covered. If it is not covered in the sense, the fraction has to be ignored. So we are ignoring this 9 months. So we have to take the number of years service as 28 years only. So his salary was rupees 6,300 per month. So they asked us to find out the taxable gratuity. So let me show you the answer. So computation of taxable gratuity of Mr. Arun for the assessment year 23 to 24. He is not covered by the Gratuity Act. So first we are writing the gratuity received. From that we are deducting the exempted amount. To find out the exempted amount, we have to compare three things. That is gratuity received 96,000, maximum limit 20 lakhs, and third one is 10-month average salary into half into number of years service. So here 6,300 into 10 by 10, so that we are getting the 10-month average salary into half into 28 years service. So it results in 88,200. So out of these three things, we have taken the least figure, that is 88,200. By deducting this 88,200 from the gratuity received, we are getting the taxable gratuity, that is 7,800. Since it is not covered by the Gratuity Act, we have ignored the fraction. Let me show you the next topic, that is pension. Pension is a periodical payment received by an employee subsequent to the retirement. So after retirement, they are getting the periodical payment, that is pension. So the pension can be categorized as two. One is uncommuted pension or monthly pension, that is periodical payment of. Uncommuted pension is taxable as salary. So the monthly pension is taxable as salary. And the commuted pension, that is known as lump sum payment. So that lump sum payment is considered as it's also taxable due to in such scenarios. First one is uncommuted pension or the monthly pension is fully taxable to the government and as well as non-government employees. Uncommuted pension or the monthly pension, uncommuted pension and the commuted pension of government employee. So if it is a lump sum pension for the government employee, it is fully exempted from the tax. If it is a non-government employee, it is further classified into two. That is, if he receives gratuity along with the pension, in the sense 1/3 of the full commuted pension is exempted. Underline the word full commuted pension. And then the next thing is that if he is not receiving the gratuity along with the pension, in the sense half of the full commuted pension is exempted. So again I am repeating, uncommuted pension or the monthly pension, that is fully taxable to government and as well as non-government employees. So the monthly pension or the uncommuted pension is fully taxable to government and as well as non-government employees. Commuted pension of government employee. For the government employee, the lump sum pension or the commuted pension is fully exempted from the tax. And the commuted pension for non-government employees is classified into two. If he receives gratuity along with the pension, in the sense 1/3 of the full commuted pension is exempted. If he not received the gratuity along with the pension, in the sense half of the full commutation pension is exempted. Let me show you the problem. Mr. R retired on 31/12/2022 and his pension was fixed at rupees 3,600 per month, that is uncommuted pension. He got 3/4 of the pension commuted, for which he received rupees 1,80,000 from his employer's A Limited company. So here they have given he is eligible for the monthly pension of 3,600 per month. He got 3/4 of the pension. So he receives the lump sum pension. So 3/4 of the pension of 1,80,000. Find out the taxable amount of commuted value. Here they have given three situations. That is, if he gets gratuity, if he does not get gratuity, if he is a government employee. Let me show you the answer. So first scenario, if he gets gratuity. So commutation of taxable pension of Mr. R for the assessment year 23 to 24. So commuted pension received is 1,80,000. So that is lump sum pension, that is 1,80,000. From that we have to deduct the exempted amount. So in that exempted amount, full commuted value, we have to find out the 1/3 of the full commuted value. So first we are finding out the full commuted value. So full commuted value, in the sense for 1,80,000 he receives for 3/4, and that is for, therefore for what is for full. So we have deducted 1,80,000 divided by 3, into 4. So 2,40,000 is a full commuted value. Out of this 2,40,000 only, he received only 3/4. So we have cross multiplied. That is it. So 1/3 of the full commuted value is exempted. So from this 2,40,000 we have calculated 1/3. So 1/3 is the full commuted value is the exempted one. So 80,000. So 1,80,000 minus 80,000, it results in 1 lakh. And the next we are getting that he is receiving the uncommuted pension. He received 3/4 of the pension. So remaining 1/4 of the pension will be the uncommuted pension. So that uncommuted pension 3,600 into 1/4 into 3 months. That is, he retired on 12th month. So 1, 2, 3 for till the end of the year. End of the financial year. So 3 months. So 3,600 into 1/4 into 3 months. So it results in 2,700. So by adding these two things, we are getting the taxable pension. Let me show you the another scenario. If he does not get gratuity, in the sense half of the full commuted pension is exempted. That is the only difference. Others are similar to the previous answer. So the first thing is that we are entering the commuted pension, that is lump sum amount 1,80,000. We are deducting the exempted one. So first we are finding out the full commuted pension. So 1,80,000 divided by 3 into 4. So 2,40,000. Out of this, 1/3 of the full commuted value. That is 1/2 of the full commuted value. So 2,40,000 into 1/2, 1,20,000 and 60,000. And we are adding the uncommuted pension as we have seen in the last problem. So the answer will be 62,700. The only difference between the previous answer and the current answer is that he does not get gratuity in this problem. He is getting gratuity. So if he gets gratuity, 1/3 of the full commuted pension is exempted. If he does not get gratuity, half of the full commuted value is exempted. That is the only difference. And for the government employee, commuted pension is fully exempted. So he need not to pay the tax on it. But uncommuted pension is taxable to all. Even though he is a government employee or the non-government employee, both has to pay the tax on uncommuted pension. So 1/4 of the pension is uncommuted. So 3,600 into 1/4 into 3 months. So 2,700. So the taxable pension is 2,700. So these are all the points relevant to the pension. And then next we are going to see the leave salary. Leave salary meaning is, as per the terms of employment, employees are eligible for leave. One of the leaves is earned leave. If the leave is standing to the credit of an employee, that is not availed within a year as per service rule, it may be encashed or it may be accumulated, which means all the employees are eligible to avail leave. If the employee is not availing leave, in the sense, it will be standing to his credit. He can encash or he can accumulate those leaves. That is known as leave salary. That is, the unavailed leave can be, he can get the cash from the employer for the unavailed leave. That is leave salary. So for government employees, leave salary is fully exempted. For the non-government employees, the rules are actual amount received, 10 months into average salary, maximum limit 3 lakhs, leave at credit into average salary. Out of these 4 things, the lowest amount will be the exempted. Lowest amount will be exempted. Note, here the salary means basic plus DASB plus commission on turnover. The fraction has to be ignored in the number of years service years. Leave at credit. How we can calculate the leave at credit? The sanctioned, as per the IT rule, the sanctioned leave is 1 month for every completed year of service minus leave availed. That is known as leave at credit. The organization may sanction more than 1 year, but as per IT rule, they can provide only the 1 month of every completed year of service minus leave availed. So from this problem we can get a clear picture. Mr. Vijayan was working in VCO Limited, which means he is working in a private concern. So he is a non-government employee. He retired from his employment after rendering the service of 23 years and 8 months. For calculating the leave salary, we have to ignore the fraction. So 8 months has not been included in the number of years service. At the time of his retirement, he received rupees 4 lakh as leave salary. His salary at the time of retirement was rupees 14,000 per month. He was entitled to take 40 days of leave for every year, but he have availed only 4 months of leave. So he has availed 4 months of leave. So which means leave at credit has to be calculated on now one month for completed year of service. He has completed 23 years of service minus he has availed 4 months leave. So 23 minus 4, it result in 19. So leave at credit will come to 19. So let me show you the answer. So the first thing is that we have to enter the actual amount received, that is 4 lakhs leave salary. For he has received rupees 4 lakh as leave salary. From that we have to deduct the exempted amount. So we have to find out 4 items. The first item is actual amount received 4 lakh. And the second item is 10 months into average salary. So 10 into average salary 14,000. So 1 lakh 40,000. And the maximum limit is 3 lakh. And the fourth one is leave at credit into average salary. So 1 month for every completed year of service. So 23 minus he already availed 4 months leave. So 23 minus 4 into 14,000. So 19 into 14,000. So we are getting 2,66,000. Out of these 4 things, the least one is considered as a exempted one. So 1,40,000. By deducting 1,40,000 from 4 lakh, we are getting the taxable leave salary of rupees 2,60,000. So here the note has given that is leave at credit can be found out by 1 month for every completed year of service minus leave availed. Through this we can attain the leave at credit. And the average salary is given in the problem. So the salary includes the salary plus DASB. Salary includes the basic plus DASP plus commission on turnover. We have to ignore the fractions. So these are all the points relevant to the leave salary. So I hope from this video you got a clear picture about the tax treatment for retirement benefits like pension, leave salary, gratuity. Thank you.